I was speaking at a conference just the other day, and unsurprisingly for me, I was talking about tax and tax planning and what the future for tax might look like. Part of that was looking at what's just happened in relation to tax with the many frozen allowances and exemptions that we are now living with through to 25, 26. And it would just occur to me to remind people of what you can still do to be tax effective and how important it is to be tax effective. There are going to be more higher rate taxpayers. There are going to be more additional rate taxpayers just because of the freezing of the thresholds. So just as a reminder, doing stuff tax efficiently will definitely help the bottom line. Statement of the obvious. Did you know? Big reminder that you can get £20,500 of tax-free income if you structure your affairs properly. So have a look at that iPad and you can see what I'm getting at when I talk about 20,500. There's a 12,500 personal allowance, a £5,000 0% starting rate band, and up to 1,000, might be 500, personal savings allowance, a £2,000 dividend allowance, and actually infinite amounts of tax-free income you can get from VCT investments and of course ISAs. Now, some of those allowances and exemptions are agnostic in relation to the income that allows you to have it tax-free. The personal allowance, you could have any income, it fits within the personal allowance. However, once you get beyond that, you go, oh, right, to use your personal savings allowance, you need to have savings income. That needs to be interest or interest distributions from bond-based investments. To get the dividend allowance, you need to have dividend-producing investments. To have ISA tax-free income, you need to have ISAs. Some of this stuff you can't do at the last minute being when I need to draw down on my investments. So pre-planning is so important. Pre-planning to have as much into your ISA, statement of the obvious, as you can to be able to draw that tax-free income from it. Okay, having your investments in equity-based investments that produce dividends, whether they're wrapped or unwrapped, helpful, of course, to do before you get to the point of drawing down, but it is possible, of course, to then transfer without any monetary limits into a unit trust or another form of collective investment, an OIC. So you can do that at the last minute. It might not be without cost, of course. If you want those tax deferred and tax-free income opportunities from investment bonds, we know it's not strictly income, then you need to have had that bond in place for a long time to make the most of the top slicing relief or the 5% withdrawal allowances if you're taking amounts out by way of part withdrawal. So pre-planning will allow you to have the best outcome. Think about things in advance, you will get the best outcome when you want to have them. Those tax-free allowances, some of which are agnostic, but some of them, as I've just reminded you, depend on where the money is. And it's your job as a financial planner, of course, to continue to have the money in the right place to enable your clients to get the right outcomes.